Welcome, everyone. I'm Pierre Daly, Managing Editor of AdvisorAnalyst.com. My co-hosts today are Mike Philbrick and Rodrigo Gordillo of Resolve Asset Management, SEZC. Our special guest is Arthur Salzer, CEO and CIO of Northland Wealth Management, one of Canada's leading family offices.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of AdvisorAnalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
Arthur, welcome to the show.
Thank you so much, Pierre. Great to see you again, Mike and Rodrigo.
Good to see you as well.
Great to have you hanging out with us today. I think it would make sense to probably kick off with you telling us a little bit about yourself, your career arc, where you started and how you got to where you are today.
No, glad to. It all began back in 1977, and I think I caught Star Wars 15, 16 times at the theater on Ottawa Street in Hamilton. And I associated with Luke Skywalker looking up to twin moons and saying, how the heck do I get out of here? And growing up on a farm until 20, I had a good dose of it. So what it really amounted to was I wanted to get out of the country. I wanted to see the world, and I wanted to learn. So I was the first student to fast track through high school in Ontario, and I entered university at 17 and ended at 20. Between high school and university, I did my real estate broker's course. So I was able to buy and sell real estate the day I turned 18. Early 20s, got out of university, was during the weak economic environment that we had in the early 90s, that 91 recession, almost depression, and did my RR, did most of my CIM. And I worked for my own family, buying real estate for them. And back then, there was no realtor.ca. I would go down every Saturday morning, go into the Hamilton real estate office, pull out the papers for the new listings, and start going through them, trying to find buildings to buy. Year and a half after that, got a job at TD Bank. I worked in retail for 2 years, lending money and in fact, taking people's homes from them, terming out their lines of credit, making their cash flow tighter, and really showing them how much the Canadian banks really cared for them. From then, I did get to go to TD Private Investment Council, but the funny part was when I was doing my CFA, the head of the region for human resources came down to meet with me, and she said, "We don't want you taking the CFA program. It's not good. It's not what we want for you, and we're not going to pay for it." And I said, "Thank you very much. However, if I waited for TD Bank to pay for my education, I wouldn't have had my real estate broker's license when I was 17. I wouldn't have graduated from university at 20. I wouldn't have done my accredited appraiser at the Canadian Institute. I wouldn't have done my RR or my CIM. And in fact, you can't tell me what I read outside of my business hours. So too bad." They didn't like that response. But fortunately, I sent enough business to the trust department that they hired me. They had to. And I ended up spending 6 years working for the founder of TD Asset Management and TD Private Investment Council, Robert Gorman. And somewhere around 2001, I determined that the bank was too limiting in what I wanted to earn for a living. And I left without a firm to go to. I was fortunate to get hired at Leon Fraser, and I worked for George Fraser, and I was mentored to him by almost 8 years. And at that point, he had been managing money since 42, 43. So somewhere around 60 plus years of investment experience. I'd already been 10 years in the industry, had a CFA designation, and it really was the icing on the cake for what I needed to learn as a professional. Leon Fraser was bought by a public company, Jovian, and we were becoming institutionalized. I didn't see a future there and left. Within a period of about a year and a half, maybe 2 years, I founded Northland Wealth in 2011. And since then, it's been a fun ride, learning a lot about various asset classes, private equity, private real estate, private debt, hedge funds, and even Bitcoin. And I would say today that we have one of the largest, if not largest, network for institutional quality alternatives in Canada outside the pensions.
And so how did you, so I suppose the formative years of actually getting your fingers dirty in the paper and looking at listings and sort of understanding cash flows has continued to sort of tilt your practice to some degree towards those types of assets. And have clients responded well to that? Is that something that is the dominant feature of what you're doing for clients as a differentiator, or is it dominant in the asset allocation? How do you look at that at Northland?
I think it's about taking experiences and using the correct parts of them to help forecast and take advantage of the future. So, for instance, my first job at TD was, again, taking people's homes from them, seeing what a real estate crash looked like. And when I left Leon Fraser, I co-founded a distressed U.S. real estate fund. And we invested in multifamily through the small states, Florida, Georgia, Texas, Arizona. And people that I told about it, they said, don't you understand how bad the real estate market is in the United States? And I said, yes, I do. I said, that's why we're buying. Mm-hmm. It's at 50% of replacement cost. Cap rates are 8 to 10% without leverage. Why wouldn't you want to do it? And it's $1.04. It was really a buy of a lifetime, and we made extreme returns for clients. And then when we started to invest in secondary private equity versus doing club deals, returns did super well. We got into tech at the right time by investing in a manager that discovered Shopify in 2011. We got in for our families at a $70 million valuation. And it's really just continued to progress. And fortunately, in 2017, I got introduced to Bitcoin. We didn't buy in 2017, but from May 2017 on, did 2 years of research before we started putting capital to work. So it's about trying to take what you see and what you've learned and use it going forward.
Can you break that down into a bit of a framework for us? The idea that is there a checklist? Is the checklist in your head? How are you thinking about that as the CIO on behalf of your families, and then also understanding that no matter how much evidence there is, sometimes things take longer or they evolve differently than we might believe. So how do you think about diversifying that risk? So two questions there. A bit of a framework from the top down, and then that in that framework will probably include some of the answers to the second question.
Absolutely. Today, people talk about data, and it's data this, data that. What does the data show? And I don't think we would have discovered anything relying on data. It's intuition that you make a guess, you make a judgment, and then you, using first principles of science, try to prove that thesis wrong. And if you can't do it, then the thesis holds. And I think that's the best way to make investment decisions. So when we look at the current state of the world, it's always trying to piece together different goings on to come up with a macro picture and then have the data disprove it. It's not what most people do, but I think it's a better approach. And again, using first principles, if you disprove your thesis, then you need to alter it or completely eliminate it because it's null and void. So you always try to disprove your thesis. I think that's the key. That's where you use data properly. So when we look at the world today and using real estate, using residential real estate in Toronto, for instance, it's very difficult to say that the average price of a home in the last decade has gone from $300,000, $350,000 to north of $1 million. And that's because the houses are better, or they've been improved in some way, or they're less, they're more rare. And that's not the case. It's simply that the denominator, the currency, is going down. And I wish it was more than that, but it's not. The trick is now that we understand there's a trend, and there can be counter trends, and there can be smaller cycles within the larger trend. But the trend seems to be there, that governments are continuing to flood the world economy with liquidity. And there's consequences to it.
So is it the liquidity, or is it inflation, or is it a combination of both to you?
There's definitely asset inflation.
Yeah.
But because of technology, inflation in things like televisions, a 60-inch screen now is what, $500-$600, and in early 2000 it was $20,000. I guess that's deflationary, but the cost of living to either rent or to buy a shelter, that's gone up. So you have to look at the pockets and be very clear on how you're trying to define inflation. But just traditional inflation, oil's about the same as it was 13, 14 years ago. Car prices are higher, but you replace them less. So there's lots of arguments, but asset prices, stocks, bonds, real estate, Bitcoin, gold, it's all a lot higher than 10, 15 years ago.
So would you say that was due to, sorry, Rodrigo, go ahead.
No, go ahead.
Yeah.
Would you say that was due to all of the money printing and there was no alternative trend in terms of sort of, the Fed and central banks in general flushing investors out of the bond market and into financial assets, into equities, into real estate?
Yeah, I mean, there's a huge push into risk assets, and people that used to hold government bonds 10, 15, 20 years ago made, call it 200-300 basis points above inflation. That's no longer the case. And with negative rates, then you can argue that you're paying the banks to hold cash. And I think with digital currencies, it's possible to speed up the cycle, where theoretically a government central bank could say, come the end of the month, we've got a new currency, and yours expires just like a loyalty points program from an airline. So that's a big change, and I think that's something that's coming. It's not here yet. It might be 5-10 years, but it seems to be the trend.
Yeah. And so we have a period since 1982 where you've been able to have a hedge to your equity portfolio and get a massive carry on that. So you've had positive carry with a negatively correlated asset to your equity portfolio, and that no longer exists. We certainly don't have the positive carry. It's possible that bonds do respond in a non-correlated way to equities. It's also possible we go through a 70s period where they are correlated to equities. So that's a possibility as well. How are you addressing that in portfolios, given that set of circumstances? How do you think about the balance in your portfolios for Northland's families?
When we talk to families or the industry, we talk about the new 60-40. And 60-40 used to be 60% public equity and 40% fixed income. And today we're actually probably 4 years ago, we were saying it was 60% public markets, 40% alternatives, whether it's private equity, private real estate, gold, hedge funds. And I think it's even swung where it may be 40% public markets and 60% alternatives. So things like real estate have done very well. It, as an asset class, exhibits positive carry. You can borrow less expensively than the cap rate for now. And that still makes it a preferred asset class for many ultra high net worth families because of the tax treatment of the return of capital through depreciation and interest write-offs. So we like real estate. And it's probably also why we bought Bitcoin. It seems to be, it walks its own path. And you might call it uncorrelated. You may not. It's a risk asset, but it seems to have its own cycle. In the shorter term, it may move with other risk assets like equities. But over the longer term, it seems to have done its own thing. And it's been a phenomenal hedge the last 2 years.
And when you think about that portfolio construction today, which is heavy on the alternatives and then less so on the public markets now, how do you divide? What's the risk curve look like for you between hedge funds, real estate, Bitcoin, and VC?
So real estate's probably somewhere between 10 and 25% of a family's portfolio, maybe even 30. Hedge funds have typically been on the credit side. Global macro, we didn't see a lot of edge the last decade, so we haven't invested there. Short managers, because of the lack of carry, they short and then they get no interest return, is difficult. And the only place where you can borrow inexpensively and leverage it up was credit markets. So most of the hedge funds have been in credit. We like private debt. Obviously, there is some competition from the banks coming back. We've seen that the last year or so. But if you can, on a net basis, lend at 700 to 800 basis points higher than what you would get on comparable corporate debt, and have better coverage and better collateral, then it seems like a no-brainer. It's not super tax efficient, but risk and return, it's still a great place to have part of your portfolio. From a Bitcoin perspective, we started with a 5% allocation, and we're probably averaging somewhere between 10 and 15% now. It's due to where we are in the cycle, and it's highly probable that if the cycle follows past cycles, there may be some point at the end of this year, early next year, where we have a 0% allocation. It doesn't mean that we won't have exposure to that asset class over this decade, but given the cyclicality that Bitcoin has exhibited, we are very careful of those 70s to 80% drawdowns.
And
private equity, yeah.
Sorry, go ahead, finish up.
Private equity, it's probably 5 to 20% of portfolios, depending on the family. Secondaries typically are the core. We like the way that it diversifies across vintage risk, as well as manager. And return versus regular buyouts or even VC is more likely to be closer to high teens, low 20s than those other ones. So that's really where we start. And then we build out a PA program from there.
So Arthur, you researched, I just want to go back to the Bitcoin. You researched Bitcoin for 2 years and then you decided to go ahead. But what did your research uncover for you that was the deciding factor?
It's common knowledge today. But what I saw was the institutionalization, the plumbing of the asset class, the on-ramps getting built. And I spent time with the heads of Fidelity Digital, with Bakkt, ErisX, some of the best VC investors in the space, thought leaders like Nick Carter, Dan Moorhead, pretty much anybody that's anyone in that space. Advisors to George Soros, advisors to Bill Miller, advisors to Peter Lynch's family office. And with those on-ramps getting built, I thought the next natural buyer would be institutions. And if I didn't see that, it would have been something for my own PA, but not necessarily for families. Because as a family office, we're registered. And that means we have a fiduciary obligation to always put our clients first and to not see any change or any, potential. Bitcoin by itself would just be too risky.
Yeah, but as a part of the portfolio, it has different. It provides absolutely. It brings a different quality to the whole portfolio. But now you said one thing that you just said also, which I wanted to ask you about, was that in the next couple of years, your allocation to Bitcoin could drop to zero. Do you mean an exit from Bitcoin completely?
Yeah.
And then given that, and given sort of the longer term outlook or outlooks that are out there for Bitcoin, how would you make an indiscriminate return to Bitcoin if you found that you needed to, or that it was something that you had to revisit? Like, would you just underweight it, or would you completely exit from it?
We completely exit. 75% drawdowns mathematically is a 50% loss with another 50% loss. And people won't go near asset class when they say that. So based on the work we did, history's shown that there's typically a blow off top and then a very large drawdown. If that were to change, if the institutionalization, that new capital came in, and because of the larger total valuation, if we didn't see that kind of momentum where you have 100% price gain in 2 weeks, we probably wouldn't go to a zero allocation. Something's changed. The data showed that the thesis may not be correct. But the thesis so far, it's an ultra cycle, and there's times to own it. And there's 1 year in the cycle you probably don't. It doesn't mean that we don't want it for the next 10 years, maybe 20 years. But 1 in 4, you probably want a zero allocation. And from a tax perspective, all of our allocation went to our family tax-free savings accounts. There are no taxable consequences of selling this asset. There's no tax tail wagging the investment dog. And that makes it much easier to sell than not. And right now, we're on 5 to 6x returns. We've been trimming because we have to, but a 5% allocation that's gone up over 500% looks good.
So this you have this thesis and you understand the cycle for Bitcoin, and you're really looking for that blow off top, kind of like a typical classic bubble type cycle. Is this the only asset class you apply that modeling to, or do you also take an active risk management role in other asset classes?
Well, this one's so much easier to see. I was around in late 99, early 2000. I saw what happens with tech stocks. That happened with altcoins as well last cycle. And it may be something that we apply to crypto going forward. So if we do have a blow off a top, all the other tokens that we looked at really are more like VC. And to have crypto winter, a real bear market, and things are sped up faster than stocks, it's possible to allocate to other crypto next cycle, but do it in the VC bucket as opposed to the digital assets. I think Bitcoin and the rest of crypto are very different animals. And to not differentiate, I think is probably doing a disservice to our families.
Now, as you got into the world of real estate and the way you thought about real estate, that framework that you kind of walked us through, is that same framework is what you applied to everything else, including Bitcoin?
Very much so.
Like thinking from an orthogonal view. And you seem that you have a pretty successful firm. How much of your success do you think stems from the performance that you created by taking a chance that I think a lot of banks wouldn't take or wouldn't allow their advisors to take? How much do you think had to do with just being at the right place at the right time through that framework versus just creating a fantastic client experience and managing the relationship?
Well, it wasn't luck. Having career risk is part of doing what's right for the families you serve. And that's the difference, I think, at Northland. So from day one, we invested in private equity. Day one, we invested in private real estate and private debt. We added hedge funds 2012, so a year out of the gate, even though I'd been investing in hedge funds since the late 90s. adding, private equity on the secondary side. As soon as it became available, it was very attractive. We put capital to work in that area. And finally, with Bitcoin, it's about taking what you learn while you're doing things like the CFA to give you some of the framework to take life experience and what I was taught by my mentor, George Fraser. And with him being 60 years in the industry, what he showed me is if you can create a portfolio that has moderate amounts of volatility, and once a cycle, you either make an opportunistic or a distressed investment. And in this case, Bitcoin was opportunistic. Previous cycles, real estate was distressed. And that's what creates the alpha. And George is there in the Morningstar Lifetime Achievement Awards, along with guys like John Templeton, Peter Condell, Stephen Jaroslawski, Rob Kremble, Warren Goldring. And that's who I was mentored by. So you want to take everything and give that to your families.
That's a great answer.
And have you seen, as you've walked forward over the last 10 years, and I suppose that Northland's going to have a 10th anniversary at some point this year. If you started in 11, so it's 2021. So I think I hope we're invited, and there's going to be a big party. Probably a
They'll
Zoom
be in
party.
Cayman.
Yeah, in Grand Cayman by Zoom.
Yeah.
So the private equity, or certainly the private equity market has changed quite dramatically, I would imagine, over the last 10 years. I'd imagine the amount of money that's chasing it now and the deals that you might see now or that you're entertaining now may have slightly different valuations than they did when you started. Or do they? I mean, I guess that's a question. Are you seeing the flood of money coming into the private space affecting the potential future returns in that space?
Absolutely. So what we've seen in the last decade was a lot of money going to growth equity, late stage VC, especially service as a software and in IT. Where we think the world's going is back to value, that the bifurcation of growth versus value is at an all-time high. And there will be opportunities in the growth, in the P space that has a value bend. So buying traditional companies that trade at lower book to price costs will provide better returns. And that's where we're starting to layer into. With secondaries, there's always a great spread between what you're going to bid and the underlying NAV. And it's easier to see what's there because the portfolio's been built. I think that is going to continue to stay to a degree. That secondary market will continue to get more liquid. And it's starting to feel like Wall Street from the 1800s, where it really was just, by appointment or over the counter. But there is a growing degree of liquidity versus what there was a decade ago. And from a risk reward standpoint, what makes private equity attractive is that you're expected to trade on material inside information. Otherwise, you won't do the deal. It's difficult in the public markets to make full decisions that you've seen everything. There's a lot of guessing. Whereas the private markets, you can take what you know, you can take what's going on at the company and make a better investment decision and pay closer to the correct price.
is there any impact coming from the SPAC world into the private equity world as they do sort of these types of deals in the marketplace?
We've really shied away from the SPAC marketplace. It seemed like a good way to raise capital, but the valuations and the multiples didn't make a lot of sense. And again, when it's in the public world, you're not going to get the granularity and the detail that you would get if it was private. So it's a way for the retail public to get access to private because you don't know what the heck they're buying. They just say they're going to do it. But it's hard to get a lot of the deeper details. So for the most part, we'll stick to the private world.
Yeah, you don't have that information asymmetry potentially.
No, I don't mind signing NDAs. I like that.
Right.
If we don't know who the investors are around us, we won't invest.
Can I just bring the conversation back to the value versus growth transition that you're seeing? I've heard a lot about this. I have my own views on it, but I'm curious to know why we think that value is going to be a better investment in the next 10 years. What particularly about value makes it more attractive in this cycle?
It's like skinny jeans versus baggy jeans. It's fashion. When you look at financial companies, the banks, for instance, they have a difficult time when interest rates are low. They've put tremendous money into their systems in the last decade. And it looks like interest rates are slowly going to start to rise. Not a lot, but they will. And the efficiency that they've picked up from improving systems and the fact that they're priced inexpensively can allow you to get a good return, or at least one that can be better than overpaying for a great growth story. And it's not that the new growth companies aren't really cool, but there's a limit that you want to pay for as an investor in order to skew the probabilities in your favor. That's all it's really about.
Interesting. So we're looking at the one of the key things you said there is a slow increase in the interest rate that makes it harder to borrow in order to buy more growth. So GameStop and the like is probably going to have some issues. But does that spill over as well to that Bitcoin cycle that you speak of when there's less free money out there? It might affect the ongoing growth of Bitcoin and leading to that
from a cycle, sure,
70% decline.
If we had a interest rate spike at year end, you combine that along with overbuying, sure, it can pull the price back. From what I can tell, plus or minus 50 might be the new lows next cycle. So we might be back here round trip in 18 months, 2 years.
Right. And it's going to go to 100 and then back to 50 is what you're thinking.
No, if it hits 100, it'll go to 2.
Now I'm thoroughly confused.
That's the problem. And if it doesn't, and it just slowly grinds, then the cycle is morphing. It's elongating, and you need to look at it maybe as a longer term growth story, less cyclical, and reduce the weight accordingly.
So you just talked about Bitcoin being a big portion of your client's portfolio, and the next cycle you're going to look to the other areas of the crypto space, right? Because there really is many categories within that, right? So you're going to find an opportunity. But it's from a VC
perspective.
Right. So you see them as companies. So you got your Bitcoin, you got your Ethereum, you got the companies that are using Ethereum as their supercomputer in order to be able to offer their unique value propositions, and then there's all the other alternative exchanges and altcoins. Have you thought about the different categories and buckets and what they may represent for you in the future or in your clients?
First off, they're companies without any shareholder rights. They're more like loyalty points programs, and the airline can change the value, the way you're treated, and you have no recourse. So that's got to be known ahead of time. Realistically, might be 2.5% exposure if private equities 2025. So you can see crypto being a tenth of P. Again, Bitcoin, it's a digital asset, it's a store of value. Now, what'll be exciting is layers getting built either above it or beside it, whether it's liquid that's been created by Blockstream out of Victoria, Canada, or if it's the Lightning Network that has the ability to do transactions tens of thousands of times faster than Visa or MasterCard. So I think a lot is going to be built on Bitcoin, but that process takes time. The DeFi side, yeah, it's cool VC, huge potential, and you'd want to be with specialist managers that all they do is invest in that space.
Mm-hmm. Yeah, it's a very good point. It's growing at such a fast pace that even the people that I know that have been in it for years are finding it hard to keep up. So most definitely you're going to need some specialists there. Active management's back in the crypto space.
Well, it's basically private equity, right? It's VC.
Yeah.
And I know the SEC is starting to consider a lot of crypto as a security, and it seems like they are. But for now, people can front run them. They can trade on material and information, and there's no consequences. So those managers that can do that in that asset class, there's still an edge. It's the 1960s, the 1970s, and that's where you want to put your capital. But, a family office with 10 staff doesn't have enough time to go through every single token and to know the story and to know what the management's doing.
Yeah, so you didn't buy the Dogecoin yourself then for your clients based on the Elon Musk research that you did?
No. The only Dogecoin or Doggy coin that I have is a style of camo on a KB2 tank I play on World of Tanks. That's my total exposure.
I like
That's
it.
your NFT portfolio.
Pretty much. Although, you look at what happens to rock and roll and musicians, after the early 90s, like after Nirvana, what major band has created great music? And they haven't, because the industry's broken. And I think if we can attach NFTs to music again, to monetize and pay these artists fairly, instead of having their art stolen from them, maybe we'll have good music again.
Yeah,
it might be a different genre, but
the transition
to
more of this. Go ahead.
No, Mike, go ahead.
No, I just want them to get paid.
Yeah,
Amen.
But it's sort of the transition to the away from a centralized hub of distribution that cannibalizes the profit margin for the actual creator, to more of a decentralized scenario where there's creators and they can go direct to market, and the market will bear to them whatever fruit and profits, largely to them and less so to the distribution platforms. And I think
Absolutely.
You're right. Music over the last number of years, even pre-Nirvana, quite honestly, was pretty corrupted. I mean, there's all kinds of musicians who had, their music promoted at a very hefty cost. And
yeah, they get a very
it's interesting.
small margin.
Like, when was the last real album produced? Maybe Joshua Tree, Peter Gabriel So.
Yeah. In the context of an album, I'm not sure.
Before that, I mean, whether it was Deep Purple, whether it was Black Sabbath.
I'm sure there's a whole bunch of millennials on this watching, just rolling their eyes going, you have no idea how much great music has been
what's
created.
What's interesting about that one, you got Drake,
you old guys.
Drake and the Weeknd.
I read an article.
Right? Drake and the Weeknd.
Yeah.
Well, Drake and the Weeknd were one of the first of musicians that really used the decentralization approach, creating their mixtapes, putting it out there, managing their future themselves, and getting significantly better distribution deals after the fact, right? After they made themselves fairly popular. And the issue with the traditional approach, which is you're begging a recording company to do all the work for you and you get 90 cents on the dollar or less, or even Spotify giving you such little amounts, is that they had to figure out how to make money with merchandise and the like. But even then, the deals weren't great, right? So what I love about the NFT approach is that if you could have independence to create content outside of that latest album, and you can sell it directly to your fans, that accrues directly to you, and it is like loyalty points, but that's okay. In that type of environment, it's exactly correct. You want to give them access to areas of your recording sessions that nobody else has. You want to give them, T-shirts and hats or whatever it is that is exclusive to those people that own your NFT. And similarly, in the arts space, my wife is an art specialist, and you see traditional artists also get screwed by the system. And most of the people that accrue value in the art space are from the secondary dealers and the art distributions and whoever you can put your art into that has a name. And today, the NFTs have a lot of artists in the digital world that weren't making any money because it's digital to really protect their art distributed, and a lot of them are not in the streets anymore trying to beg for money. They're actually making some good dough. So it is an interesting space, especially for the creative world, for sure. It's very exciting time.
I read an article this week that Apple is paying artists a penny a stream. And wait, that's the gross. That's not the net, because they have to share that. They have to share the penny a stream. So I mean, is music popularity now basically the equivalent of a social network, viral post where you're hoping you get 100 million streams in order to make any kind of money? I mean, everything is Live Nation now, isn't it? I mean, most artists are making the bulk of their annual revenue from touring and selling merchandise. So it's not really.
Dan Aykroyd takes the cut of that, doesn't he? Wasn't he invested in Live Nation?
Yeah, then yes. If yes, then yes. I don't know.
You're gonna laugh. So since 1976, from a Paul Lynde Halloween special, this crazy band comes down from an elevator, smoke and fire everywhere. And I went, oh my God, who are they? And it was the rock band Kiss. And I've followed them ever since. And I was fortunate to be interviewed by Gene Simmons 5 years ago at the Art of Marketing in front of 1,000 people. And these guys understood the value of what they created for their fan base. Was it the best music? No. It was entertainment, great entertainment, and they monetized it from shirt sales, buckles, radios, into Kiss coffins and everything else now. And I'm sure they'll find a way to create an NFT for their estates so their families stay wealthy. But they've always been outspoken on how the industry was broken or one of the other bands I followed, which was Metallica, and they sued Napster, and they won. And that was part of my research into Bitcoin, because you can't shut down the Bitcoin network like Napster, like LimeWire. They all got shut down. It's much more like BitTorrent. So that's what appealed to me. But I followed that story from the 90s.
Yeah. Yeah, it is. It is very much like torrent, and you're seeing a lot of countries in the world. Oh, you're seeing some. India recently this weekend, I think Turkey banned Bitcoin, and when in the past when it was Napster, you could walk into the server room and ensure that you shut down that server and it was toast, and you could sue the person that created and ran it. In BitTorrents, every single time they try to shut down that server, there's just so many other. It's in every computer everywhere. They found it increasingly difficult, and they stopped completely. And similarly, in Bitcoin, it's got enough uses internationally, both legitimate and more legitimate than ever, and will continue to be. So good money is chasing bad money out. But I would find it very difficult to see, especially the one that has the highest network effect, to be shut down in any significant way. Bumps, ups and downs, 80% drawdowns from here as this nascent technology continues up, for sure. So caveat emptor, but it is an interesting technology.
It's a life form. Satoshi created an electronic life form that it's almost impossible to stop. It's a virus.
It's an emergent phenomenon, for sure.
Yeah. So it's fun to watch.
So let me ask
Arthur,
you down
on you. Go ahead, Rodrigo. I was just going to ask you if you saw, if you're planning on looking seriously at Ethereum.
Again, it's more a VC play. It would just be in a different bucket. So, I talked to this really smart guy a few weeks ago about it. I think his name's Mike Philbrook. And apparently Mike compares it to oil, which I thought was a phenomenal analogy. So that's what I'm using from now going forward.
There you go. There you go. Bitcoin's the gold, and Ethereum is the petrol that makes it roll.
Yeah.
Arthur, you started investing a while back for your clients, and the regulatory landscape has shifted and continues to shift here. I'm curious to hear how you dealt with allocating Bitcoin for your clients in the family office space, and how do you see that going forward as an advisor? Do you think it's business as usual, or is it going to be much more difficult to help get clients exposure to this asset class?
Well, it's easy with all the ETFs and closed-end funds available in Canada. We accessed a precursor to QBTC privately through 3iQ before QBTC was publicly listed. That's how we got exposure. And from there, we've used QBTC primarily, as well as a couple of other ETFs. That's where, as a professional, we will access it for our families as a security or wrapped in a security. But what I find is a lot of family members of all ages, from the founding generation to grandchildren and great-grandchildren, want to be able to learn about it and to custody it themselves, whether it's through a hot wallet or a cold wallet. And the fastest way that I can show how powerful the technology is to have an 82-year-old client download an app on her phone, and 5 minutes later, she's got Bitcoin. And she's like, wow, this is way easier than opening a bank account or setting up all my trust with you guys. This is the way it should be. And now I can do something with my great grandkids. So there's a huge light bulb moment where they start to get it. And although we didn't have that as much, we actually brought out Dr. Xavier Moose, the author of the Bitcoin Standard, in November of 2019. And we hosted a presentation for about 60, 65 people and dinner for 30, where people would just throw them questions and learn from one of the preeminent experts in the world. And it wasn't a sponsored dinner. We had people from the Bitcoin industry, even from Mike Novogratz's family office came in. We had everybody from crypto in Canada that really was part of it, and our family members. And they got to interact and bounce ideas of each other. And it was great. We even had this former junk bond salesperson trader, a guy named Greg Foss. And he met a lady who works at another hedge fund, a credit hedge fund, who didn't believe in it. And his first line out is, how about I give you 10 to 1 odds that Bitcoin goes to zero? And she goes, yeah, that's about right. Good. And he goes, well, I think it goes to 1 million. So based on the math, today Bitcoin's at 8,000. It's worth 100. Do the trade. And then her light bulb went off. She went, oh, I get it now. So there's just different ways to explain it. Is it an option, a perpetual option? Is it an asset? Is it a collectible? Is it communication? Is it language? It's all of those things.
And did you have to go through a big learning curve for your clients when you first introduced it, or were they already up and ready to go?
The Inquisitive took us up on our presentation offer. And, we had 24-ounce sous vide steaks, porterhouses for everybody, crypto carnivore dinner. It's the only way to go. And vegan options. Because Safe eats 5 pounds of steak a day. That's all he eats, steak and water. So we gave everybody the real experience. People that didn't attend, I had some people screaming at me in a boardroom. And they're like, we've talked to our lawyers, we've talked to our accountants, we've talked to advisors. And they say, it's all a Ponzi scheme. Why would you make this investment? You don't know what you're doing. And then I ask, well, have they met all these people? And they're like, well, no. I said, well, I have. And I probably have met Satoshi. So go do what you want. We'll sell the position, but I'm not going to apologize to you. And 2 years later, everybody's looking, going, my God, I can't believe we're here. And, it's added, 5% to our returns, across portfolios on a 5-year basis.
Yeah.
So it works.
Yeah. How do you, I'm just going to move away from Bitcoin for a moment, back to the sort of the more higher level portfolio thoughts. And given that you're focusing in some private equity and private real estate, how do you think about geographical diversification? Are you mainly in Canada and North America? Are you able to source deals from the globe? And then when we look at sort of forward-looking expected returns for asset classes. We look 10 years ago, bonds had nice juicy returns, US equities had nice juicy returns, and those have come down quite a bit. Emerging markets, call it value, whatever the case may be, have sort of inverted and now have much higher expected returns over the next 10 years. And so how are you thinking about that with respect to the private equity, private real estate side of the business? Are you staying home, sticking to your knitting and diversifying through public markets? Or do you have access to, some emerging market private deals. How are you thinking about the global diversification in the portfolio, given the tilt that you guys have taken?
Yeah, so when Northland was created back in 2011, most of our real estate exposure for our families was either their principal residences and what other private real estate they owned. And again, distressed through the Smile States, so U.S. distressed. We found a very good REIT manager, private REIT manager, that specialized in C-class apartments. My family owned them, managed them since I was a child. I can't take client monies and put them into my family's real estate, but I knew what to look for, what was properly run. And when this manager started doing joint ventures with KingSett Capital, with some of the smartest real estate investors in Canada, that was the final check mark. And we allocated tens of millions of dollars to Canadian multifamily, specifically Ontario. And we've generated high teens for the last decade. So it's worked very, very well. Probably 2.5, 3 years ago, a lot of the positions from the US had been sold off. We started to reallocate and to build our US position up. So reducing our Canadian multifamily, reducing Canadian exposure, and adding more in the United States, Europe, and a little bit in Asia. And right now, it's funny, but we see a lot of opportunity in hotels. So we're with one of the best global managers in the hotel space, and it's only probably a third of their portfolio, but they're allocating to that sector. They've done some very newsworthy moves the past month and a half, and we see some very good return profiles from hospitality.
And do you guys incorporate any kind of precious metal exposure, or is that sort of covered through your crypto exposures?
We have gold, and I think it'll be an okay rate of return going forward the next decade. Year to date hasn't done well, but it does seem with the digitization of the world and the way the next generation is putting capital to work, that gold's becoming antiquated. It's still there. It's still real. But if one hedge works significantly better than another one, and it looks like it's going to continue in some ratio like that, we might be to a point where we have no gold exposure and only Bitcoin to hedge that risk, along with other real assets like real estate.
And then how does real estate perform in sort of more inflationary environments? Let's hypothesize just for a moment that rates rise.
As an asset class?
Yeah.
Or a one-off where you're doing improvements with how you...
More of an asset class. You're looking for some distressed areas and whatnot. I get that you're trying to put the probabilities in your corner. But how does that asset class respond to higher than expected inflation and interest rates? Is that a significant challenge? Is it the type of real estate? How do you view that, or do you not view that as a potential risk?
If you've got rent controls, you've got a large risk. So it takes a while for the government to allow you to spool up rents. You want escalators in the commercial space, and again, things with shorter rental periods allow you to increase the rates faster. Longer leases, obviously, it's like a long duration bond. Interest rates go up, the value of that lease goes down dramatically. So in general, rising inflation or rising interest costs will be a strong headwind against real estate. And you need to look at real estate opportunistically, where either you can add value or you can be in areas that allow you to get the rents up faster. It's not a perfect hedge, but in general, shorter leases in a rising rate environment would be better. It's like a short duration bond.
Right. Gotcha. Great. Very insightful. I think those who are thinking about this space as they listen to this podcast are their wheels are going to start turning and saying, okay, I need some real estate and whatnot. And I remember RioCan, being the first REIT back in '93 that I bought for clients, and no one else would touch it because it was just a brand new asset class in Canada and had a very sort of slow and steady rate of adoption. And it just goes to show sometimes you are rewarded for being an early adopter, and then there's lots of times when in a kind of asset class can fizzle, and you want to make sure you manage your risk in those areas. But the way that compounding works is, if you lose, as you mentioned the Greg Foss story, if you lose all of your investment in one, but you've made 10 of them, and half of them have actually been 10 baggers or had much higher excess returns, you're playing the numbers, if you will. You're trying to get those diverse sets of bets in the portfolio, understanding that some will inevitably not work out, and that's okay.
Yeah, and
What's interesting,
I did catch. I don't know if you were an investor in Boardwalk, but I was an investor for clients when it was a publicly traded stock before it converted to an income trust, and it was difficult to sell in the high 50s, low 60s with an $8 cost base, but it was something that we had to do, and it worked out. It was a great call, but I think 8 times their money in less than a decade.
Yeah. I mean, what's interesting about what you're describing is when I got into the business, my clients' portfolios were 100% alternatives, a diversified book of alternatives, which is way out of bounds from being an advisor at a bank. Luckily, I was an independent. What advice would you give to... This is a channel geared to advisors. What advice would you give to the traditional advisor that's had a hard time with traditional asset classes and is thinking about taking a step towards the alternative space?
The dispersion of return in alternatives is much, much wider than the public markets, much wider by a magnitude of 10. If you can get access to top quartile managers, don't invest in the asset class. It's that simple. And that's why I think there's so much pushback by a lot of professionals about investing in alts. Because if you're only getting the median, or God forbid, third quartile, fourth quartile, your returns can go to zero very quickly. Whereas a broad-based equity fund, not a sector fund, but a broad-based equity fund, maybe you underperform by 2% a year. Maybe you outperform by 2% a year. But when the standard deviation of private equity is 10%, dispersion around the median, it's too easy to lose all your money. So if you don't get best in class, it's better just to not invest there.
So buyer beware.
Caveat emptor, absolutely.
Yeah. Interesting. I think there's so much talk around alternatives these days, but very little of it centers around what you just said, which is that the dispersion of returns between issuers is so wide that you really have to do your due diligence. You really have to do your homework when you're looking at the space, or forget it. Yeah.
And you need clients to be able to write $5 million checks too.
Yeah.
Right. Yeah. There's barriers to entry.
there's huge, right? The great managers, it's 5 to 10 million. And as an MFO, you can say, well, we'll do one check for 2, one for 1, a couple for 500. And now people with 500 to get a 2, 3, 5% allocation, that makes sense. But otherwise, they could never get in the door.
I wonder how crypto is going to solve this fractionalization problem of the big managers. Yeah, get in there, buy a big chunk of the good managers, and then tokenize it, sell it to the world. Get in there, crypto.
Break everything up into satoshis.
When they get too large, the challenge becomes is the returns come down. So there's a balance between a growing best-in-class manager and one of the stalwarts that's they're just to collect, assets. They're large publicly traded PE managers. So for instance, we don't have capital with the Carlyle Group, but I was introduced to David Rubenstein's daughter, Ellie, who was starting up her own PE fund called Mandatory Partners in the food, agriculture, asset class, the sector space. Out of the gate, the fund's done 50% IRR first year, and we've got a multiple 1.6 net of fees. But that's how you want to approach the asset class. She sees what the Carlyle Group sees, but they can't invest there. They're not specialists. So they just pass it along. And she has a phenomenal professional team around her. And that's what, makes a difference. But you got to have deal flow, which is proprietary, and you need institutional structure to make sure that day-to-day business operations work. But being part of a $10, $15 billion buyout fund, I don't see a lot of edge. You might get median return, but you're not going to get top quartile. It's less likely.
Right.
Are there any alternatives? Are there any alternatives in your portfolios that are sort of the more democratized versions, where the availability isn't necessarily targeted at ultra high net worth?
There are some very good private debt managers that have wrapped their LPs with mutual fund structures that you can put into an RSP. And they're quite good. They're Canadian centric. Most times, some involve lending in real estate in the United States, but that's a way to get access. And one of the first things that we tell a business owner, if they were going the RSP route, is to look at IPPs. Because it's not so much that they're taking more money out of the company or we're going to get more assets to manage. An IPP can invest in limited partnerships. An RSP can't. So all of a sudden, the world becomes your oyster and you can allocate to more places. And if you have good opportunities, you're going to get better returns. But there's some great private debt managers that are RSP eligible.
Okay.
Fantastic. I guess it's also another theme that runs through, I think, successful investing. You really have to think about what it is that you're trying to accomplish. And most investors may think that an advisor is always trying to accomplish the best returns at some level of risk. But that's not always the case. When you have investment boards, sometimes there are a number of different items of importance that they're trying to fulfill. Like they would prefer to go with a very large manager who's approved across all of the various allocator, sort of the Mercers of the world, the allocator consultants. And that's achieving access to the asset class with safety in numbers, right? All your friends are doing that. But if all your friends are doing it, it's not going to achieve returns that are different than all of your friends. And so if you're trying to find managers within asset classes where you think the asset class could outperform and you'd also like some extra performance on top of that asset class, you're going to have to look for more of the emerging manager class, the ones that don't have as much assets, the ones that may not have a 10-year track record. And you're going to have to think from first principles on how you can get access to that if, in fact, your objective is to have those returns in excess of any said benchmark. And so there's going to be a level of discomfort that's required. And many people won't do that. And if you won't do it, that's fine. But you shouldn't expect that you're going to get these, sort of unusually unique return vectors either.
No, and if you want to talk about neat stuff, it was probably 2013, plus or minus 2012, where I took a serious look at risk parity, the all-weather structures. And of course, I read a lot of, work from, I'm trying to think.
Bridgewater.
What's the big Bridgewater? Yeah, all their stuff. But then there was this other Canadian manager who somehow was part of an IROC dealer. And I thought, what the hell are they doing there? But they had phenomenal research. And it was part of the work and the due diligence I did. And we ended up allocating to AQR because I wasn't going to allocate to an IROC dealer. But part of that, exploration was the work that you guys had done. And it was great work. And then that allowed me to pivot into risk premia and looking at things like low volatility investing, and read a lot of work on that, but I didn't like the way the indices were constructed. So very fortunately, at the same time, 2014, BMO came out with ZLB, and we were in the door in the first month. And it wasn't because the wholesaler knocked on our door. It was because of the work that I read from this Toronto firm.
Totally
agree. Thank you.
No worries. Raising the average
the word out, that's for sure.
Connect the dots.
Yeah.
All right. Well, thanks, Arthur.
That feels like a good place to start to wrap up. We've been at it for about an hour, just over an hour. So thank you, Arthur. I know Pierre's got some parting questions for you. So we're also
one more question.
Okay.
It's would you rather question. Would you rather spend a week in the past or a week in the future? And why?
Week in the future. Something new. Let me learn. Why repeat history? So definitely in the future. How far? Be fun to see 1,000 years.
Oh yeah. There you go.
Yeah,
sure. End up in a burnt out Earth, scorched Earth. Everybody's in Mars.
Post-apocalyptic.
Someone's watched Twilight Zone from the 60s.
I thought you were an optimist, Rod. Went right to dystopian.
Well, everybody's in Mars.
Future.
I think life in Mars is going to be fantastic. You just.
Mike,
I hope you can also teleport to Mars.
What's the definition of an optimist?
Oh gosh.
Or pardon me, a pessimist, I should say.
Oh, a pessimist. I don't know.
An optimist with experience.
Yeah. Exactly. Well said.
All right. Arthur, thank you so much. It's been
really appreciate it.
It's been a very enlightening conversation. Thank you.
Thank you so much, guys.
Thanks, Arthur.
Yeah,
The
thanks,
views and
Arthur.
opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of advisoranalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.